Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, besides just a regular chart of the S&P 500, to get a read on the overall market environment, what would it be and why? And about a month ago on this channel, on my YouTube channel, I shared a chart of the 10-year yield, the $TNX, which is a 10-year yield index from the CBOE, and showed a bearish divergence, suggesting a downturn in yield, suggesting relative weakness from financials and other cyclicals, and a short-term period of pullback or downtrend. What I'm seeing now is basically a completion of that pullback, a rotation higher in rates, which should provide a good tailwind for financial stocks, and we're starting to see those charts break out. So today we're going to talk about the bullish breakouts in financials. So the chart of the 10-year yield really tells you a lot about the overall conditions for the economy. A lot of people use it as a way of tracking overall economic conditions. And in general, higher yields, higher interest rates mean a healthy economy, especially when you're coming out of all-time lows, which is what we've done. However, at some point, it starts to indicate some concern. It indicates inflationary pressures, or at least concerns about inflation, and so forth. So there, at some point rates go too high and people start to get concerned. But the Fed meeting this week and the messaging from Chairman Powell and others sort of suggest they are completely fine with rates going a little bit higher than where they're at now. And that's what we're seeing follow through the course of this week. Before we get to the implications of that, particularly for the financial stocks, banks, asset managers, and others, I want to offer you, please subscribe to my channel with this sort of thinking about investor decision-making, charts, technical analysis, investor behavior. If all that's interesting to you, please consider subscribing to the channel. I'd love to have you along the ride with me. Also, give the video a like if you could. We certainly would appreciate it. Put a comment below. Tell me what you think about the financial sector for the next couple months. You think it's setting up for a positive trend or more defensive, and why? Let's get to the charts. All right, so we'll start here with where we were about a month ago. And again, if you missed that video, go back in my YouTube channel. You can see the video where we talked about the impact of falling rates. And basically, we recorded it around mid-late March, where we saw higher highs in the 10-year yield, lower peaks in the RSI. And this pattern is called a bearish divergence, where you have higher highs in price, lower peaks in momentum. And it suggested that rates had gone too far too quickly. If you look at a chart of the TLT, which is the long bond ETF, you can see an inverse of this pattern. You see lower lows in price, higher lows in the RSI, a bullish divergence. And that makes sense. There's an inverse relationship between bond prices and yield. So the negative signal you had in rates was we're indicating that bond prices should bounce. That's what we've seen. Now, what's happened in the months or in the weeks since we recorded that video is that the yields have indeed gone down. Bond prices have bounced off of long-term lows. You've seen the 10-year yield come down. You've seen the 10-year yield reach its ascending 50-day moving average and now just start to turn higher. Also, you're seeing it remain above the 1.5% mark. And I think that's the most important line in the sand for rates. As long as they remain above 1.5%, I think overall we remain in this sort of elevated rate environment relative to where we were a year ago, and indicates potential strength for certain types of stocks, which we'll get to here in a moment. Another really telling part of this chart, by the way, is the fact that when rates pulled back, the RSI, the measure of momentum, remained above 40. And in a bullish phase, the RSI tends to not get much below 40 on pullbacks and tends to become overbought on upswings. And so the action for the TNX for the last couple months sort of confirms this overbought condition. Things should pull back, but overall still remaining in a bullish phase for rates, suggesting higher rates from here. And again, what's interesting about that timely indication relative to what we heard from the Fed this week is a similar message, sort of, long and strong, rates can go higher, nothing really to be done until rates get 2% plus. I think that's where you start to see the Fed potentially start to make some changes to address higher rates, but overall, not a big concern. And I think that gives room for rates to go higher here. Now, what happens when rates go higher? Well, it tends to provide a tailwind to certain parts of the market, in particular, the financial sector. And we'll look here at the XLF, which is the financial ETF. We can see if you look at the price overall, the price of the XLF has been pretty good for the last 6 months, but focus on the relative strength line here at the bottom. You can see when rates started to accelerate to the upside, you can see the relative performance
of the financial sector versus the regular versus the broad S&P going higher, meaning financial stocks are outperforming. Look at what happened from mid-March to mid-April. See, the relative strength line is coming down. This is when the growth trade sort of rebounds, right? The FANG stocks all of a sudden spring to life. Microsoft, Alphabet, and others rotating to new highs, while financial stocks are pulling back a little bit. Now you can see in the last week or two, you can see the relative strength line for financials rotating back to the upside, because higher rates, if rates are appreciating, that's a tailwind for financial stocks, for banks, especially for regional banks whose business is really built on the shape of the yield curve. Higher long-term rates allows them to make money on the spread between short-term rates and long-term rates. So a higher 10-year yield in general tends to be a good sign. So the chart of the TNX looks a lot like the relative performance of the XLF. Another one we don't have time for in this video, but if you look at the ratio of the XLF, the financial sector, versus the XLK, the technology sector, you can see it looks very similar to this as well. Rotating down over the last month or so, but really rotating higher in the last week as financial stocks starting to reemerge because of higher rates. So what happens in this situation? Well, overall, higher rates should be good for financial stocks. Overall, I'm not surprised to see the XLF making a new high, seeing the relative strength start to turn higher. And remember, that's actually during a week when most big tech companies seem to be reporting. You have some semiconductor names reporting. You have big stocks like Microsoft, Alphabet, Apple, all reporting earnings this week. And you've had mixed results, right? Google and Microsoft doing two different things this week based on their earnings results. But overall, those are sort of netting out to an okay result, while financial stocks are actually continuing to push higher this week. So overall, indicating that financials over tech seems to be the play here for the near future. So I ran a scan. I ran for stocks ranked high using the StockCharts scooter ranking. This is a proprietary ranking system. You can see that in the scooter ranking column. These are stocks ranking higher based on their trend profiles, and as a long-term, medium-term, short-term component to it, it's weighted a little longer weighted a little more to the long-term side of that. But overall, it's telling you which trends are strong. And I'm going to highlight a couple of names that actually score pretty well based on that right now. Charts in the financial sector that are setting up very nicely, just in strong trends. Wells Fargo is one of the top ranked large cap stocks in the financial sector. And you can see in this case how the prices continue to go higher, higher highs and higher lows. The pullbacks keep getting higher. We rotate up, has not touched its 50-day moving average since the end of January, which means it's a pretty strong upward trend. You can see the relative strength line has actually been in a pretty consistent uptrend since November. So overall, it's been in a pretty strong stretch of performance. COF is Capital One Financial. You can see this is obviously a credit card issuer, consumer finance company. Again, you can see this trend of higher highs and higher lows actually pulled back to its 50-day moving average into mid-April. This is when the 10-year yield came back. Now that it's rotated higher, you can see that COF is going up to new price and relative highs, which is pretty constructive. Ally Bank is obviously an online bank. You can see how this price trend has just been in a consistent uptrend. The relative strength has been in a consistent uptrend as well. And it's not just the smaller companies or companies outside of the major banks. This is Goldman Sachs, sort of an investment bank. You can see how this is not making new highs just yet, but it's really, really close this week, testing its all-time highs from March. So Goldman Sachs, as with the other banks, pulled back to their 50-day moving average, sort of consolidated a little bit, and now rotating back higher and testing those all-time highs, but overall setting up pretty well. So what's interesting is if you look at the financial sector, you can find a broad number of the stocks that are actually testing very well based on their trends. Overall, they're in strong uptrends. And you know that just from the prices making higher highs and higher lows, but you also know that based on the StockCharts scooter ranking, which is a proprietary model that measures overall trend strength. I actually noticed the strength in financials earlier in the week when I do my weekly routine of looking at a series of stocks identified on Monday, Sunday into Monday. The number of financial stocks are actually popping up, rotating higher. On Wednesday, I usually run a new 13-week high list. So looking for stocks making new 3-month highs. There were a bunch of financial stocks on there this week, more than we've seen in recent weeks for sure. So overall, we're seeing this pattern of higher rates. We had seen a pullback in rates to the 50-day moving average, now rotating back to the upside. That should provide strength to value stocks like financials. Energy stocks, by the way, start to usually correlate pretty well with financials in this sort of environment, which suggests good tailwinds for performance from energy as well as financial, sort of the value part of the market. Overall tends to be a headwind for growth stocks, things like big technology, communication services, and consumer discretionary. So very interesting to see if the performance in financials is enough to outperform the performance in some of those other sectors by the fact that the relative strength lines are turning higher in pretty much every one of the financial stocks that I showed you. Overall, it seems to be setting up pretty well. So this is the overall thesis of higher rates, what that means for financial stocks, other value-oriented sectors, and how the outperformance that we're starting to see in financials could be a further tailwind for further outperformance. One final comment I'll make that I was noticing as I was looking at charts of things like Ally. A lot of people look at the RSI, the measure of momentum, and see if they're starting to become overbought. And they say, okay, this is a problem because if it's overbought, that means it's gone too high and you're probably going to get a pullback. And you've seen that sometimes. So if you look back on the chart here in June of 2020, the stock became overbought. You can see it pull back a little bit. Overall, though, what I tend to remind people is this quote: overbought means up a lot. That's not a bad thing. The stock is overbought. That actually means the price is going up a good amount. And you can see, particularly on the chart of Ally Bank over the last 6 months, you can see a number of times where the stock becomes overbought. And while sometimes you'll get a brief pullback of a week or two after an overbought condition, overall, it's all about how the price pulls back. And as long as we keep making higher lows, which a stock like Ally has done, it's not, you shouldn't be afraid of the fact that the stock is making new highs. Should not be afraid of the fact that the stock is becoming overbought. What you want to be worried about is when the stock stops becoming overbought, when it does not become overbought on a big push higher. That's where you can start to think about, bearish momentum divergences, lessening of momentum, a lightening of bullish sentiment, a lack of buying power. All of those things would be indicated by the stock not becoming overbought on a push higher. Overall, these stocks entering the overbought region speaks to trend strength, and overall nothing to be concerned about at this point. Lower highs, lower lows, that's the concern. We're not seeing it anywhere on the chart of financial stocks.
So there we go. That's our breakdown of the of rates with the potential to go higher, what that means for financial stocks, and overall just the fact that if you screen on stocks making new highs, you'll find a lot of banks, a lot of other financial firms on that list right now. Overall, if this sort of thinking about investor decision making using the message of the markets themselves using charts, that's of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along on this ride with me. Also, give this video a like if you could. We certainly would appreciate it. We value it a great deal. Finally, put a comment below this video. Let me know what you think of the financial sector. Do you give it a thumbs up or a thumbs down for the next 3 months, and why? From everyone here at Market Misbehavior, I'm Dave Keller. Be well, be safe. We'll talk to you again soon.